Right. Welcome everybody. Welcome back to the sixth episode or the Six Colored Money Show. We're discussing property and property as an investment. I've got my reservations about it to a certain extent, but it's still. I mean, historically, it's one of the best asset classes. It's one of the safest asset classes, one of the best performing asset classes over a long time. Let's say that, not necessarily over the last 5 to 10 years, I would assume. But Jaco will tell me if I'm wrong on that. So before we get started, let me introduce our guest, or our guest introduce himself. Jaco Grobbelaar, please go ahead. The floor is yours.
Right.
Introduce yourself. Tell us about yourself, about your business, and what it is that you guys do.
Great. Good evening, ladies and gentlemen. It is such a privilege and honor to be on the show tonight, and I'm really, really excited to talk for about the next 30 minutes about property as an investment class and how one should approach property as an investment. My name is Jaco Grobbelaar. I'm the founder and CEO of Prosperity Enterprises. Now, Prosperity Enterprises is all about helping individuals to build and protect wealth through proper structuring and property investment. So I'm very, very excited for tonight to share a little bit about myself. So my background is actually finance. I was a CFO for an international wholesale firm, and property was always a hobby for me. So property investment was always something that I did on the side while I was building my corporate career. And then about 5-6 years ago, I had the privilege to full-time go into property. And that is where things really took off. And yes, I'm excited for what we are going to discuss. There's some great topics and some great aspects of property that we are going to discuss tonight. And thanks again for having me on the show, Rieyaan.
Oh, welcome. Thanks, and thanks for joining us. Thanks for taking the time out to join us. Brandon is there to sort of keep me on track in case I ask questions that I shouldn't be asking as well. But sometimes he asks those questions for me. So Jaco, I mean, the question that I really have is it still a good time to invest in property? The reason I ask this is because we've seen it. Well, let me start with this rather. About a month or two ago, I did an article by Magnus Huystek, and you must have seen it yourself. The R1 trillion property collapse in South Africa. You've probably read it yourself. I think it was at the end of June. And in this article, he says that the property market has been in a steady decline in South Africa, and that that's been on a downward trend, and it's not necessarily in line with inflation for the last 13 years. Something to that extent. That's what he mentioned in the article. Is it then a good time to invest in property? Sure, in residential property specifically. Sure, we see interest rates are low, but is it risky to get into certain markets within the property sector in South Africa, or is it not? What's your opinion on that article, that statement as a whole?
I think there's different angles to look at this thing from. It's very important to understand the returns of property. And sadly, very few people actually understand how property as an investment class works. And very often when analysts speak about property, they only look at a certain aspect of property and they don't take the whole thing into consideration. So something that's very, very important to keep in mind when you look at property as an investment is to understand the returns and to understand how those returns work, because there's a couple of things that you need to keep in consideration. Firstly, in property, you've got two returns. On one side, you've got the asset that is appreciating in value. Now, let's talk about that just for a couple of seconds. And when you look at property, as an asset and the appreciation of property over the last 50 years, if you take any 20-year average, you would have an average year-on-year growth of over 10%. I think the lowest that you'll get to, if you perfectly time those 20 years somewhere in between that 51 years, I think the lowest that you get to is 9.8 or 9.9%. So if you take a step back and you look at the picture from a little bit longer term, your capital appreciation, the growth of the asset, has actually been very, very good. But keep in mind now, ladies and gents, that is only one aspect of your return, because on the other side, you've got what we call your rental yield. And that is the rental income that a property is generating. So let's assume you are buying a property cash, and most people don't buy property cash, which is a topic on its own. But let's assume you buy a property cash. You need to consider both the capital appreciation as well as the rental yield, or the rental income that property. Now, we talk about net rental yield, which is basically your annual rental income after your expenses. So those two returns combined gives you your return unleveraged or ungeared if you would have used only your own cash. So let's say, for example, currently the average growth in South Africa is far below that 20-year average. It's on just under 5%. And then your average gross rental yield in South Africa is about 10-11%, whereas net rental yield could be somewhere between 6 and 8%. So let's say you make a good investment where you've got a 6% year-on-year growth on the asset, and you've got an 8% net rental yield, then you're sitting on a 14% before you even bring leverage into the picture. So I think it's very, very important to look at the facts for yourself, and then to also understand the returns of property, and to take a step back and to look at a longer term picture as well.
So, but that capital element is obviously unrealized, right? So it's not, I mean, the capital element with regards to the property, you only realize that gains when you do decide to sell the property. Am I not correct, or am I wrong in the making that statement?
That's true on the one side, but remember, it's still part of your wealth. It's still part of your asset base. And there are other ways to access the capital portion, which a lot of people don't understand, because you can have a property, you can rent it out, and instead of selling it, you could, for example, refinance it. Now, that is something we often do with properties. We would buy a property, usually below market value. We would give it some time, maybe to appreciate it a little bit, and then we would refinance the property. Now, what refinancing means is I can buy a property for 800,000 Rand. I can finance it for 800,000 Rand. And then let's say in a year's time, if that property is worth R1 million, remember, I probably bought it below market value as well. I could refinance that property to R1 million, meaning I go to the bank and I say, bank, I've got this property, it's worth R1 million. Currently, my bond is 800,000. I would like to borrow an additional 200,000 Rand. Now, what I love about financing or refinancing is the fact that 200,000 Rand that I'm getting, guess what? It's tax-free. I'm not even paying tax on that, because it's exactly like you say, it's still unrealized. And in property, you only pay tax on your capital gains if those gains are realized and that is when you sell the property. But what if you never have to sell the property?
So you basically use the property as leverage, basically, to get equity, or to get funding. Sorry. So
Absolutely.
Then what would you then say? Then what would you then use that 200K for? Where would you advise people to actually put that 200K? Would you advise people to reinvest it into more property, or to look at other asset classes that are potentially yielding a better return than property right now? I mean, in your opinion, I'd probably look at putting it somewhere else, but I'd like to get your perspective on that. Brandon, maybe you could answer that question. Sorry, first before Jaco goes, and then Jaco, maybe you could give your answer afterwards. Sorry.
What would you do? I think go for it, Jaco. I think give us some examples, like sort of easy to understand examples of how you would go about it.
Okay. Perfect. Yeah, Jaco, you go ahead.
I think there's 4 or 5 things that you can consider with refinanced funds. As I said, with the refinancing, the capital that we make available, in effect, what we end up doing then as property investors is we are building an asset base without using any of our own money, because the money that you make available from refinancing doesn't just have to be used for other investment. It could be used for that investment as well. So if you, for example, have a property investment that still has a shortfall and you've refinanced once, you can actually use that refinanced money to cover the shortfall. So that's, for example, one thing that you can do. And we very often do that, because suddenly that R1 million asset becomes an asset that's not taking a single cent out of our pocket. And if you can do that, the size or the asset base that you can build is significantly bigger than in any other asset class. So that's one thing that you can do with the money. Even before that, and I think, ladies and gents, that's the most important, is like with everything, you need to have reserves. You need to make sure that you keep your portfolio in a healthy place. And for me, there's one way to do that, and that's cash. You need to have a certain percentage cash on hand. Now, that cash I would usually park in an access bond, because when I park it in the access bond, I'm not paying interest on that money while I'm not using that money. But that money is accessible for me in, for example, in the case of an emergency. And our personal rule is to at least keep 10% of the value of your properties in cash and in your access bond. So that would mean for every R1 million property that I own, I want 100,000 Rand in cash. And that 100,000 Rand, you don't have to use your own money for. Like we said, you can refinance it. Then, thirdly, you can, so we said, and I want to put that one first, you can use the money as a reserve for safety. It's like an emergency fund. Number two, you can use it to subsidize the shortfalls of that particular property. Number three, you could use it to acquire additional properties. So with property investment, we will always try to use as little of our own money as possible. So we'll always apply for a 100% bond, and we'll always take the bond for as long as possible, because we want the cash that leaves our pocket to be as little as possible. But there's still, for example, going to be transfer fees and bond registration costs, and those are things that can then be covered by the reserves or the refinanced funds that you've made available. So that would be the third thing for me. The fourth thing for me would be, Rieyaan, like you've mentioned, and that is to take that money and to maybe put it in different investment vehicles or asset classes. And then lastly, you can even use that money for your own pleasure and for your own benefit. Obviously, you want to benefit from your investments as well. So if your investment portfolio, your property portfolio is healthy, then you can use some of that money for yourselves as well.
So, I mean, that sort of gives quite a few options there, and it makes it quite clear as well. I just think that as a new potential buyer, I mean, let's say you're a 26-year-old and you've managed to save up about a 300K, and you're thinking of going into property now, or putting money into, like we always say, cryptocurrency. Like you think you're putting that 300K into cryptocurrency. In your opinion, where would you put the money? Because if, bearing in mind, you're going to buy an apartment of, let's say, R1 million. I mean, what the transfer costs on that R1 million would probably take a significant chunk out of your 300,000 Rand investment or 300,000 Rand capital. Whereas with regards to cryptocurrency, you're putting in, yes, there's the element of risk associated with cryptocurrency, and that's where property is probably a bit better than cryptocurrency as an option. But how would you convince me as a 26-year-old, no, don't put it into cryptocurrency, rather put it in go into property? If that is what you would do.
I would like to use a simple example and to really explain the power of property with that. And with that, I'm not saying that one shouldn't invest in other asset classes, but I do believe that property should be a very significant part of your investment portfolio. Now, let's talk about leverage and property and how those two go together, because there's an element of leverage that you can bring to property that's very, very difficult to bring to other asset classes. And I want to use simple numbers. Let's work on R1 million property, and let's work on you having 100,000 Rand to invest. So let's say you've got 100,000 Rand to invest, and you manage to buy R1 million property at 900,000. Now that's something that's very possible, because of the fact that property's greatest weakness is also its greatest strength. So property is very illiquid, and there's a lot of subjectivity around the pricing of properties. It's not like in different asset class where all the units, if I may say, look exactly unique, or you look exactly generic or the same. and it can be perfectly priced. There's a lot of emotion, there's a lot of subjectivity when it comes to property. You have people immigrating, leaving the country, willing to dump their properties at whatever price because they feel they need to get out. You've got people divorcing and they want to get rid of their properties. You've got people that are in financial distress, and because of the debt that they have to sell the property below market value. So all of those opportunities to buy property below market value. Now, let's assume you can buy a property at a 10% discount, and you can do significantly better than that. But a 10% discount, you buy a R1 million property for 900,000. You've got 100,000 of your own money, and you acquire that investment. Now, there's two elements that I want to talk about. Buying the property at a discount, because the value of the asset is so much more than the money that you are putting down, you actually can make a significant return on your cash just because you bought the property at a discount. Let's use that example. If it's and we will take out variables such as the costs to acquire the property as well as the rental income that it generates, just to simplify the example. But you can have a profit on the acquisition of the property that could easily be 50 or 100% in comparison to the deposit that you've put down or the cash that you've put down. And that's one side. But then on the other side, I want to talk about leverage. Let's say you didn't buy it at a discount. You've got R1 million property. You've used 100,000 of your own money and 900,000 of the bank's money. If that investment grows with 10%, it's not your 100,000 that grows with 10%. It's the value of the property, the million, that grows with 10%. So if that property grows with 10% from R1 million to 1.1 million rand, and you owe the bank 900,000 rand, that means what we call your equity, your asset value minus your debt, is 200,000. You've put down 100,000. That 100,000 has been turned into 200,000 now. That's 100% return on your cash. So even though the investment only grew with 10%, your cash grew with 100% because of the fact that you are using the bank's money. Now, something that's very, very important to keep in consideration when it comes to leverage is what applies to the one side also applies to the other side. Because if that investment or that asset or that property only decreased with 10%, that means 100% of your cash would have been wiped out, because the R1 million property would have dropped to 900,000. You owe the bank 900,000, and the 100,000 that you've put down is gone. So leverage amplifies what's already there. If there's a small positive return, leverage can turn it into a big positive return. If there's a small negative return, leverage will turn it into a big negative return. Now, one last thing that I want to say is the reason why property and leverage go so well together is if you look at the last 51 years of property prices in South Africa, there are only 3 years where property prices actually declined from the year before, and that's 1985, 1986, and then 2009. 48 of the other 51 years, there were positive growth. Now, for me, that's huge, because if you are sitting with an asset that tends to keep its value well, like property does, and that doesn't easily lose value. So in other words, it maybe doesn't go up so fast, but it goes up consistently. Then you can leverage that asset. And then you can turn a 6 or an 8 or a 10% return into a 60 or 80 or 100% return. And that's exactly what we have done with property.
So would you advise people who are renting now, I mean, people that would potentially enter the lower bracket of property, they're renting for, let's say, 7 to 10,000 rand a month, or let's say 10,000 rand a month they're renting. Would you advise them to buy a property now instead, to take advantage of the low interest rates and buy now? And on top of that question, what sort of a twofold question, what then if interest rates increase? Surely the installment will increase and the returns would be reduced, or the returns would be reduced if they're buying it as an investment property and they decide to continue to rent as well.
Rieyaan, that is such an important question, and I think it's very important that one thinks of all the aspects before you make this decision. What I would always advise my clients when it comes to the question of renting versus buying is that if that property is investment class, or it's a type of property that can give you a good return, then absolutely rather buy than rent. If that property does not make sense as an investment property, in other words, you wouldn't have put it in your investment portfolio and rent it out, then it doesn't necessarily make sense to buy. Now, a person that pays somewhere between 7,000 and 10,000 Rand rent, I'd like to see those, or I see those kind of properties as very good investment properties, because there's a lot of people that want to live in properties like those. So there's a lot of demand for properties like those. Also, when you go look at the numbers, when you go look at the rental yields that those properties in those price brackets yield, or those price brackets give you, as well as the capital growth, it makes a lot of sense to buy in that. What you've mentioned about interest rates is extremely important, because interest rates has got a massive effect on your return on investment, or your internal rate of return. And hence, you need to make very sure that your investment doesn't just make sense at the current interest rate, but at also a couple of 100 basis points above the current interest rate. So, and that also is why the reserves that we've spoken about is so important, because you want to have some fat, you want to have some reserves when interest rates, for example, increase. For me, there are 3 reasons why buying is better than renting if the property is investment class, as we said. And the first reason is you don't have to pay a rental agent a commission to manage the property, because usually you would buy the property in an entity, such as a trust or a company. You would then rent that property from your entity, and you would pay rent like any other tenant to the landlord, which is the entity. Now, the great thing about renting from one of your own entities is you don't have to pay the rental commission. So there's already a 10% plus saving on the rental income, or an increase in the rental income that you earn. Then secondly, you don't have to be so concerned about defaults or about tenants not paying you, unless if you're concerned that you're not going to pay yourself. Then obviously you should rather rent. And then lastly, the third reason is any improvements that you make on that property is not just for living or for lifestyle or for convenience. Any expense or any changes that you make to that property is for your benefit while you live there, but it also increases the value of the property and the future rental that you can earn on that property when you move out and you put a tenant in.
So you were speaking from the perspective of someone that's bought a property under either a trust or a company and renting from their particular trust or company. So, I mean, that sort of brings us on to another aspect as well. Sorry, there's something flying around here. What the argument of buying a property in a trust or in a company or as an individual? I mean, I'm quite certain most people would agree the best option is probably not the best option, but the worst option is to buy it in your own capacity as an individual, if you are looking to purchase it as an investment property. But the argument of buying under a trust or under a registered company, I think that the fact that the company probably gets taxed, I speak under correction, I think a company gets taxed at about 20% versus a trust, which is around the 40-45% mark, depending on the income that the trust makes. So your opinion, would it be better then to buy it under as a trust or versus a company, or vice versa?
So a company's tax rate is lower. So currently, as we speak, a company's tax rate is at 28%, whereas a trust's tax rate is at 45%. Now, most people hear that and they immediately think that a company is a better option. However, in a trust, you can do things that you can do in no other entity. And one of the things that you can do in a trust is what they call the conduit principle. And how the conduit principle works is that any profit or capital gain that the trust makes, you can distribute to the beneficiaries. Those could be your children or your grandchildren or yourself or your spouse or your parents. And the individual that receives that money, they will be taxed at their tax brackets and with their exemptions. So very often you would actually pay less tax in a trust than in any other entity. But to talk about structuring and why you would or how you would buy property, I always say you need to run your property portfolio like a business in its own entity, with its own bank account, and with its own financial statements. And the reason for that is you'll be able to build a bigger property portfolio, meaning you'll be able to get more financing. You'll be able to protect your assets better. It's better for estate planning, and your taxes will be significantly better.
Also, Brandon, I don't know if you maybe have one or two questions that you'd want to ask or throw at Jaco as well, or discuss. I do have a couple of more questions that I could lead through, but I want to give you the opportunity as well, just to get in on this as well.
You know what's interesting though is there's actually there's so many different things you can invest in nowadays. You know, if you look back a couple of sort of 20, 30 years ago, you really sort of had property was your main one, or you had equity markets. Now there's so many different things, there's so many different options available to you as a potential investor. I mean, you've got ETFs, you've got the equity market, you've got cryptos, you've still got the property market, you've got the bond market. You know, there's so much out there, which is fantastic, which is great. But it lends yourself to the fact to really go and find out and do in-depth research. I mean, we've always been saying on the show, do your research on the asset class or the investment that you're looking at. You know, I think, and that's what the show is really trying to do. We're trying to put people on the show who are experts in their field, who can help guide you with that decision, with sort of where to look at. You know, I like cryptos. Does that mean I don't like property? No. But the next guy might like property. He might not like cryptos. You know, so it's all about, and it's not just about your risk profile. It's about what you feel comfortable with, what you feel at ease with. You know, so we spoke last week about cryptos, for example. A lot of people want to invest in cryptos because I think it's a get rich quick scheme. They think if they give you 50,000 rand today, they're going to make R1 million tomorrow. You know, because they see these astronomical returns and it all looks exciting and it's wonderful. But how many people have been hurt, you know, from cryptos? You don't hear about the people that have lost a lot of money from cryptos. So I think it's also important just to understand what it is that you want to invest in, do the research on it, and ask questions, and find the right people who'll guide you in that manner. And I mean, Jaco knows, we've said many times and discussed property. I was never really big on property. I think for me, I was always concerned about, you know, having to chase people for rentals if you own a property that you're renting out, and the risk of finding the right tenants, because what happens if you're getting tenants who aren't paying, especially now with COVID? You know, how many people haven't been paying with COVID? You know, you can't get them out because it's like, number one, it's a moral issue, but number two, the law's on their side, not on your side. So those are also risks that you need to think of. And maybe Jaco, maybe you can speak to that, because I know you've got a lot of properties that you've got. I mean, what have you found with COVID? I mean, have you found a lot of guys not paying? Have you found guys sort of still paying? Have you had issues with tenants trying to get them out? You know, maybe a bit of insight into that.
A very important aspect of property is, of course, rental management or property management afterwards. And the first thing that you need to consider, and that is so important, and I'm glad you brought it up, Brandon, is that your vetting needs to be excellent, because that's the beginning of rental management. Is if you vet properly, you're probably going to have much less trouble with tenants. If you vet poorly, you are probably going to have a lot of trouble with tenants. And then also to focus on the right kind of investments. There's actually phenomenal stats out there that gets put out there on a regular basis on what is actually the percentage of tenants that don't pay. And the percentage of tenants that don't pay in the right price brackets is in the vicinity of 4%. And that's average, meaning that if you do better vetting than the average and better management than the average, you could bring that down even further. So default or non-payment is definitely something that you have to factor into your model and that you need to consider as part of the investment as property. But that risk can be greatly hedged by applying a few simple principles diligently. One can, of course, take rental insurance out as well, which is not that expensive these days anymore. All of this obviously eats into your returns, but it is ways that you can hedge yourself from that risk. And a lot of investors actually do consider that as well. So that's definitely something that one can do as well.
But hasn't it been a bit difficult for investors to actually find those kind of tenants of late, especially over the last year? I mean, I'm not sure. You could probably advise us on this. I'm sure that a couple of your customers have found it a bit more difficult to find that tenants who are in that perfect bracket that you just described right now. I mean, with employment, the employment issue in the country right now, surely that caliber of tenant has diminished or decreased.
Absolutely,
which adds another risk to property as an investment, I guess.
We are definitely, if you take the percentage of tenants or tenant applications that gets accepted to be placed in one of our properties, that percentage is definitely lower, which means the work that needs to go into vetting is much harder, and sometimes even means that you need to compromise on the rental that you are willing to accept. Rentals have definitely been under a lot of pressure the last 2 years. On many of my units, I had to reduce the rent from what I used to get before COVID, just to keep the units filled, and also to keep it filled with good tenants. So that's definitely something that one needs to consider as well. I see that we are running out of time, and one thing that one thing that I must say that is really so important, and that's not just applicable to property, but I'm going to speak from a property perspective tonight, and that is to have the right picture in your mind of where it is that you want to go, and to think about the objectives of why you are investing. We very often say that property is a long-term game. There is a lot of wealth that can be built by property, and there's a lot of principles that you can apply that can get you very far by investing in property. But it takes time as well, and you need to be very patient with something like property. So it's definitely not a get in today and get out tomorrow rich kind of investment, but it's a very sure way to build wealth. And that's why you will see a lot of your very wealthy people have built a lot of that wealth through property, or have stored and built further their wealth through property if they have made it in something else.
Awesome. So, Jaco, I know we're running out of time. Just one last question. Seeing that, I mean, you're an advocate for property right now, investing in residential property in South Africa. Firstly, do you think it is the right way to go to continue to invest in South African residential property? And if so, where do you think is the best location within South Africa to invest in residential property?
Ladies and gents, I think it's absolutely the best time to invest in property. The Rothschilds would have a saying that is very often repeated, and that is, when there's blood on the streets, that's the time to buy property. And I think very much with what is not just going on in South Africa currently, but globally, is there's blood on the streets, and we are acquiring property at prices that we paid 10 years ago. So it is really a great time to get into property. Terrible time to get out of property, that's for sure, like with most investments, but a phenomenal time to get into property. Interest rates are low, property prices are low, and there's a lot of upside. There's a lot of opportunity for growth. Something that I often mention, you don't need a doctor's degree in economics to understand that, but land prices are not getting less, labor is not getting less, and raw material prices are not getting less. Yet, property prices for the last 5 to 10 years hasn't performed as well as it should have, and hasn't increased as much as the input costs, which means that at some point, there's a good chance that a correction needs to take place as well. So is it the right time to invest in property? Absolutely. And then where to invest? I think more importantly, what to invest in within property. I love residential property because people may not need an office tomorrow, but they will always need a place to stay. And I love entry-level property. There's not a lot of very wealthy people that can rent luxury accommodation, but there's a lot of people that need a roof over their head. So if you can stick to a basic property, I very seldom would go over R1 million. And in fact, I think one should go even less. One should go even less than 750. It will depend from city to city, because you're not necessarily in Cape Town and Joburg, you're going to get a completely different property for 750,000, for example. But stick to the more affordable property, because the demand in that price segment is much higher than in other segments. And then where to invest, that's a very, very difficult question, because it changes. I mean, Cape Town has been popular for a very long time. Then COVID came and it slowed down quite significantly. Joburg was a phenomenal place to invest. And the last 10 years plus, we've seen oversupply in Johannesburg that has also kept prices down. We've suddenly seen a lot of increase in the Eastern Cape, where the Eastern Cape was never really featuring from a capital growth perspective, or a place for property investors to invest. And a lot of people are investing there now. The same applies to KwaZulu-Natal. So I think there's opportunity in all of these places that I've mentioned now, but stick to the basics, stick to the type of properties that people need to live in, not just a few people, but the masses. And I love cities for that matter also as well, or close to cities at least, because that is usually where the work is, and that is usually where the growth is as well.
Awesome. Thanks very much, Jaco. Brandon, I don't know if there's anything else that you want to add on to that. I don't want to steal another half an hour of Jaco's time, even though I probably could. If I could have this conversation with you for another hour at least, Jaco. Thanks so much for joining us. To everyone watching, we've shared Jaco's Twitter handle in the description, and that's both to his personal Twitter handle and his business, Prosperity Enterprises. Feel free to contact them through those links. You'll probably find the links to their websites on their Twitter handles as well. If that's okay, Jaco, if that's okay with you, maybe they could contact you and ask you a few questions. But yeah, thanks very much, Jaco. Hopefully we could get you back on to discuss a few more things with how to invest in property, and where you could potentially save with regards to using your property as a savings tool, if I could say that. Just one last thing before we go. Please note that everything we discuss is merely our financial opinion. It's not financial advice. If you want financial advice, speak to a registered financial advisor. And I think we can end it off there. Thanks very much. Thanks, Jaco. Thanks, everyone. Bye-bye.
Thank you.